January 5th, we sold merchandise for cash. So we sold stuff, got cash for it, plus sales tax payable. Do we get to keep that sales tax payable? No way, no how. Okay. So how did we figure out how much actual cash came in? Well, we have to take a look at our sales revenue. We had $20,520 in our cash register. So that cash amount went up. We do not get to keep all of it. How do you figure out how much you get to keep? Well, we have an 8%, sorry, that got a little bit messy. We have an 8% sales tax rate, but remember we take it either times 1.08 or divided by 108%. You guys remember walking through that? So you can do it two ways. You could either take 20,520 times 1.08, or you can do it the way that the book shows there. To figure out, well, what was our actual sales revenue? What actually came in that we get to keep? We get to keep 19,000. But then when you take the cash minus the actual revenue, that's what is payable. That's the liability. That's the stuff we have to send off based on sales tax. So 1,520. And I know I mentioned Junk by Jenny a lot, but once I became an official business last spring, I had to have that payable amount ready to go to the state of Minnesota, because I charged that to my customers. So I had to be ready to pay 6.875% to Minnesota based on my sales that I made. And then when I went and sold at a special little flea market vendor fair in South Dakota, I had to pay their sales tax. And then it was a special event, and it was a little bit more. So I had that money in my account, but it was earmarked as a payable because I owed those places. Even though I had the money. The cash came in, it wasn't all mine. Okay, let's go to the next one. January 12th. Performed services for customers who had made advance payments of $10,000. It tells you right there, credit, service, revenue. Well, when we get money for stuff we haven't done, Breyer's exactly correct. Unearned service revenue, and it told us right away to do service revenue as the credit. What is unearned service revenue? A liability. We owed previously, and now we did the work, and like unearned became earned, basically. So in this case, the liability is being reduced because it said performed. We performed services. They'd prepaid for them before, but we did the work, so the liability goes down. And it becomes revenue instead. January 14th, paid State Revenue Department for sales taxes collected in December 2013. So this is just like when Junk by Jenny paid the state of Minnesota. I paid my State Revenue Department for sales taxes collected. You don't even have to figure out the amount they told you. What's going to be the debit and credit here? What's going to go down when we pay something that we owe on? Yeah, cash is going to go down too, but the payable is going to be debited because that normally was a credit, but this is, the payable is now paid, but we used cash to do it. So they both go down. We used cash, cash goes down to pay a payable, which also goes down. That liability goes down as well. What's going on the 20th? Sold 900 units of a new product on credit. So they pay cash for that. What's going to be our big debit there if someone buys something from us, but doesn't pay cash? AR, very good. But there's sales tax. So is the AR going to be $45,000? 900 times 550? No. Why is our AR 48,600 when they bought 900 things times $50 each? What's not factored in? Let's reread it. Sold 900 units, 50 bucks a crack, plus what? Plus the 8% sales tax. Our sales revenue was 45,000. But what payable is hanging out there? Oh, I did that. No, that's right. We sold 900 at 50 bucks a crack times 8%. So that's why our AR looks so big. It's because that we have our sales plus the sales tax that happened because of it. Why does it say sales tax payable? Why is that liability going up? Our customers paid us that. Well, they owe us that. Do we get to keep that sales tax though? Nope, that goes off to the state of Minnesota. $21. We borrowed $27,000 from a bank. If I walk into a bank and say, hello, I'm here to get a loan for $27,000, what's the bank going to do? Give you the money. You're going to get a cash debit of $27,000. But what else comes with that? Notes payable. Typically a current liability that you're going to get paid off soon, fast. When you go to a bank and ask for a loan, they're going to give you the money. Either in, cash form or a check form, something. And then on January 25th, we sold merchandise for cash. We sold stuff, got cash, totaling $12,420, but it also included some sales tax. I want you to try that one on your own. It's going to look exactly like January 5th, only different numbers. Please try that on your own. Do January 25th, that's going to look a lot like January 5th. Try it on your own. We got a bunch of money. Some of it's ours. The others are payable based on sales tax. Got a lot of cash. Only had $11,500 in revenue. And the rest of it's payable to the state of Minnesota. Remember, you can do this two ways. If you don't want to take the cash divided by 108%, you could multiply it times 1.08. 8% is the sales tax. It's just how do you get at the number? Whichever way you like using better is up to you. Yes. So that they're not showing it right. You're like that. Okay. So the multiplying is not the right way. Okay, thank you for mentioning that. So this, I'm sorry, I was getting ahead of myself. I was forgetting to do, surprised I didn't see that. I had that in my notes. Thank you. Do you have the A, B, C thing on your workbook? Okay, good. Because they asked us to journalize all the January transactions, but then in B, they asked us to journalize the adjusting entry at the end of January for two things. So we got through our months. They must do things on a monthly basis instead of an annual basis for adjusting entry purposes. And they stop and say, okay, let's adjust for things we need to adjust for. And they told us the two things. I'm looking at page 555B. Journalize the adjusting entries for January 31st for two things: the outstanding notes payable and the estimated warranty liability. Let's just break this down into two different ones. How many note payables do we have? One. Okay. Have we accrued some interest? We haven't paid the interest, but have we accrued some? Yes, we took out a note payable on January 21st. It's January 31st. We technically have accrued some interest that we owe on that, and we need to tell Uncle Sam about that. We're not paying the interest yet, it's just happening. We have an interest expense and interest payable of $60, and I want to tell you how to get that number. We have the expense of, how did I write that? One note that's payable. The book tells us to use 1/3 of a month. And I'll explain that in a minute. Of interest that's accrued, not paid. We haven't paid our bill. It's just that a little bit of interest has happened. Now the book tells you, and if you look at the book where to come up with the 1/3, hint, use 1/3 of a month for the bank note, because it's only the 21st or the 31st. So we took it out on the 21st, and we're doing the interest here 10 days later. So to get that, 27,000 times our 8% times 1/12, principal times rate times time. But then they said, okay, take that dollar amount times the 1/3 of the month that we've used it. It's kind of weird. I get that it's kind of weird. But we've had it, the $27,000 note at 8% interest for 1/12 of its life, $180 times the 1/3 of the month, because we took it out on January 21st and it's only January 31st. So that's how we got it to 60. Have we paid that? No, that is a payable, but we just have to talk about that it even exists because it's accrued. Now the second one is talking about some warranty. I want you to go back up in your book on page 555 and look where it talks about on January 20th. We sold these 900 new products at $50 a crack and charged 8% sales tax, but this is subject to a 1-year warranty. And down below it says we're estimating about 7% of them are going to be bad. And remember, warranty expenses always happen at the time of the sale. So you're going to have a warranty expense and a warranty liability. The reason it's that $3,150 is because we take what we sold times an estimated 7% that are going to be bad and come back to us. Notice that's not warranty payable. We don't owe anyone for these. It's just a liability that we're going to assume as a business expense of selling new products that we don't know how they're going to shake out. We are not doing Part C, as I mentioned. I do apologize a little bit on the confusion of the 108%. Jacob, thanks for rerouting me on that. So divided by 108% is divided by, when doing the math, 1.08.